Hello investors, today I'll speak about three dividend stocks, about dividend income, dividend and passive income. And now it's a tough year, so I would like to receive a stable cash flow. So today it will be our best three dividend stocks for today. So let's start with the first company. It's Johnson & Johnson. It's a healthcare company. Its dividend yield now is about 3%. This is much better than about 1.7 yield offered by average dividend paying stock in the S&P 500 index, and the high yield will only help you retire faster if underlying business can be relied upon to maintain and raise its payout. A diverse collection of healthcare related business has allowed J&J to raise its dividend payout for 60 consecutive years, so it's very impressive, very impressive. So by the way, if it's 60 years, I can tell it's dividend king. While famous for consumer health brands such as Tylenol and Listerine, pharmaceutical and medical technology generate heaps more cash for J&J bottom line. In fact, the company generated more than 17 billion bucks in free cash flow over the past year, with cash flow that are more than adequate to meet its dividend obligation. J&J can also make strategic acquisitions. Last December, it's acquired Abiy Ahmed and its line of Impala heart pumps for 16 billion bucks up front. Now it's one of the 12 medical technology platforms with more than 1 billion bucks in annual sales in J&J's lineup. Let's have a look on its fundamental parameters. So we can see that the market cap is more than 400 billion bucks. So it's a very big company. The dividend yield, as I previously said, is around 3%. Let's have a look on the valuation. Now the P ratio is 22 and the PS ratio is 4. So generally it's near the average P ratio. Price per earnings, the average for last I guess 5 years is around 24. So now it's traded with no discount or with a premium. Let's have a look on the marginality on the revenue. So look, we see that the last years we see a revenue grow. If it was 2010, it earned 81 billion bucks. So last year the company earned 95. So very impressive revenue growth, and the marginality is net income margin is 19%. And of course we see a gross margin of 68. So everything okay with the marginality. We see a very stable business. The company show a very strong growth, and of course we see the last 5 years the net income margin is at least 17%. So very strong marginality and profitability parameters. Let's have a look on the dividend. So we see the dividend yield now is 2.9%. The payout ratio 66, so it means that 66% from its net income J&J pays its dividends. So here there is I think a room even to increase its dividend payments. So of course it's good news for our investors. Let's have a look on the dividend history. We see that the dividend yield was 2.7. now it's about last year it was 2.5. so generally it's around 3%, 5.6%. and of course the dividends, yeah, we see the amounts, the dividend per share is continued to raise. As I told you, previous to the company 60 years continue to increase its dividend payments. So of course it's very impressive, very impressive figures. And if we will have a look on the financial health, financial position and solvency of the company, so amount of debt, if it was 30, here it was 40 billion bucks. Yeah, we see the debt is increasing for this company, but at the same time the free cash flow staying at the same level. Usually from the free cash flow the company pays dividends, so it's a good It's a positive sign. And the amount of cash, we see that last year the company had 14 billion bucks as cash in its balance sheet. So also I see any problems with this debt that the company already has. And of course, if we'll check the balance sheet, in the long run, the assets are 132 billion and liabilities 54. So this the amount of the equities here is assets minus liabilities. So it's also a positive sign for J&J. Let's have a look on the chart of this company. So here, last 3 years we traded in increasing channel. Now traded in the lower border of this channel. And also, by the way, I think now it's a good level to buy the stock, because now we trade it at the pre-coronavirus levels. And by the way, here their side momentum indicator now is 33, so the stock already ever sold on a weekly time frame. And the last time we saw such a low momentum, it was this corona crisis crash. So it was 3 years ago. So now it can be a very nice time to buy the stock. You may receive a 3% dividend yield. Also a great company with a huge dividend history paying. And of course the momentum, the technical analysis telling us that now it can be a very good time to buy the stock. The next stock for today is CVS Healthcare. It's also a healthcare company. It offers you now a more than 3% dividend yield. At the moment, CVS health stocks offer more than 3% yield that could soar in the years ahead. Over the past 10 years, the company raised its payout by more than 100%, and the best days are still to come. CVS earnings have climbed in recent years because in 2018 it acquired Aetna. This leading health insurance benefits manager collects premium from approximately 35 million people with over than 9,000 pharmacies and more than 1,000 walk-in clinics. CVS Health can provide many of the healthcare benefits it's also paid to manage. The pending acquisitions of Oak Street Health and Scientific Health that CVS Health announced in the recent months could take the company much further in this direction. Let's have a look on the fundamental of CVS. So its market cap about 100 billion bucks, dividend yield more than 3%. If we will check the valuation, look, the valuation very low. Now the P ratio is 24. Maybe it's not cheap. By the way, it's increasing here, but we see that the PS less than $1. Actually, it was last 5 years. So, but it means that you may buy $1 of its revenue for 31 cents. So it's very cheap here. And also we can see the net income margin is very low. It's only 1%. But the last 5 years, the company was stably profitable. And of course, the net profit margin is were not so high. Last 6 years it was around 1%, 2%, so it's not a highly marginal business. But anyway, we see a revenue grow. So look, I guess here the increasement for the last 6 years is about, let me check, from 2 billion to 100 billion bucks to so it's more than 50%. The grow in 5 years, the revenue grow more than 50%. So it's a very positive sign. And the dividends, the payout 72%. And here we see that the company pays. Let me check if it's grow. Dividend per share. No, it's very stable. The growth is here last 3 years. But anyway, the company we see a dividend history at least 5 years. So of course, it's a very good sign for dividend investors, and the debt here is decreasing. We saw it was 89%, and last year it was only 70 billion bucks. So the company decreasing its debt level. Of course, it's a very good sign for the investor. The amount of debt on the balance sheet is becoming less and less. The company is paying the amount of interest payment in the decreasing, and of course I like such companies. Let's have a look on its on the chart. So I remove this one. So look, here it's very interesting. In my mind, this one, I guess it was an impulse. So the first wave, the second, the third, the fourth. It's by the way looks like triagonal. Usually triagonal you may find in the fourth wave, and it was the fifth wave. Now we had a correction, ABC move, and also if I use the Fibonacci levels, I can tell you this that the correction here is very close to finish. Look, now it traded at 75 bucks. The wave C is 160% from the wave A. So here we may see another decreasement, maybe in 5-6%, but it's limited. So here most probably we may start. It can be the bottom for the correction, and about around 70 bucks, 72 bucks. And let's have a look on the last stock for today. It's a Medical Properties Trust. It's offer you a dividend yield more than 14%. So I guess the dividend yield is huge. It's really very impressive. But why? It's supposed to be a reason why the company offers you such a huge dividend yield. So the company offers sky high dividend yield because investors are worried that the company will have to reduce its payout for the first time since 2008. Medical Properties Trust is a real estate investment trust, so it's a rate that offers 444 hospitals and other acute care facilities spread throughout the US and 9 other countries. As the rate, it doesn't have to pay income taxes as long as distributes at least 90% of profits to shareholders as a dividend. And this rate typically generates highly reliable cash flow because it doesn't run its hospitals. The company recently fell after the company reported their rare quarterly loss. Prospect Medical, one of its larger tenants, is having trouble paying its bills, while there is a strong chance that the rate will need to lower its payout to compensate. This company has transitioned properties from troubled tenant to ones that can pay it in the past. Even if Medical Properties Trust streams its payout, buying some shares of this stock on dip gives you a great chance to come out ahead over the long run. So generally speaking, look, now we traded the level at $8, but it's a major support level since 2008, by the way. But here also a nice level, it's 12%. It may be a bounce to this level. In this case there is a growth potential of 43%. Of course the company may cut a dividends payment, but now it already 14%. If it, for example, cut it twice, so it will still maybe 6-7%, and it's a lot. The stock already oversold. We may see RSI momentum indicator of 31. Last time it was such low, it was the times of financial crisis in 2008. So already the momentum to buy it can be very nice. By the way, the financial crisis, it decreased to 3, even to no, to $3. Now it's $8, so it also maybe it can you tell it's still the things is not such bad in this company. So anyway, of course it's a risky company, but the risky reward here it may be huge. I like the dividends, the technical analysis also give me a nice positive notes. So generally speaking, it was my my video about dividend stocks to buy right now. Of course, today it was most of the companies, healthcare companies. The dividend yield is at least 3%. So of course, if you liked this video, so press the like button, subscribe to my channel, and of course, see you on the next time. Bye.